Greetings, market rebels. Welcome to this week's macro measure video, along with sector situation. There it is. It is Sunday, December 8th, 2024, I believe. Last I checked anyway. It's a little bit in front of 10:30 a.m. here on the East Coast. I'm Wayne. We're going to get into it. Apologies ahead of time. It's going to be a mess as it usually is, maybe even worse than usual. Here's our trusty market rebellion disclaimer. Here's our trusty, I should say, our trusty intellectual property rights notice. And then this may have been missing slide from what last week. I can't even remember, but I'm just flashing it just in case. I did have a slide that just went haywire and disappeared on me. I went with a pure stream last week. I was selling, kind of joking around, saying I'm selling you the approach that works for me. This is why. I think I may have covered this, just because it's really relates right to this week, which I'm calling betwixt and between again, because we have to. I'm skipping the balance of the notes. This was last week. I flashed last week's stuff. So I talked about the still amazing potential in the market, but wanted to start chiming in with a little bit of the warnings last week, just to give a little bit more balance, because we've been having to say like up and away for the longest time. And despite showing that can persist, and it often does, much longer than most people would believe, we still have to respect the risk. This is why this game doesn't really get easy, because as soon as you get super comfortable and think, as Judge Schmales would say, think you've got the stock market beat, then you've got to really be on guard even more than usual, which is, during normal trading times, you do need to be on guard. So in the short run, of course, probably a little more than the long run, but it still matters. And I'll talk a little bit about that, I think, at least from my perspective. Here's our very quick review of the prior week. Major aims of our discussion are always pretty much the same, just keeping it nuts and bolts, not going into the super complicated techniques, schools of thought, et cetera, et cetera. We just stick with basic stuff on your charts. We just try to identify the market environment and try to arrive at a news neutral, most likely scenario, while highlighting bearish and bullish risks that maybe are not getting enough attention in our opinion. Always set the playback speed to 2x if I'm at the helm, just because of my own personality and OCD. I try to put some helpful points below typically. This week, all it really is going to be is these major developments. Let me get the laser pointer really quickly. I think we had good fortune really to stumble upon the mega cap stampede. You can talk about how things look good and they're setting up. And we tried to do that last week. And sometimes you just don't get follow through. You just don't. And fortunately, those followed through, which was nice. So it probably was worth us spending a little time with those charts and the OA and what that would mean to the market, especially the Qs, which really, of course, finally started to close the gap with the SPY. But overall, they were dormant. We were talking about how those /XLK, that was really one of the main holdouts, along with, of course, SMH. But they got those mega caps going, and boy, it was really a tremendous move. So that was good fortune. SMH, have to say, right, once again this week, warning signs or gangland manipulation, right? I can't figure out what's going on here. Probably someone that's got a better handle on which is why I would love to have that kind of research, but somebody that has a good handle on what's happening in many ways, but especially maybe on the fundamental side, would probably have some good insights. But to me, just the SMH sitting it out, NVIDIA sitting it out, really having a rough week in the second half after starting out pretty well. Yes, I get that short term overbought, no question. Backing up a little bit, yes, but usually when those things, they usually churn for a little bit, back up a little bit, and usually when they're firing, of course, they don't do that for very long, and they join the party, and they really just still haven't. So is that one of the pieces that needs to finally join to really put this market over the top and produce the take your breath away melt up that we continue to say hasn't really appeared, at least in my opinion, hasn't appeared to this point. Doesn't have to. It's not a prerequisite, which is part of the notes this week. But that's one thought of mine is that usually you get this final, my gosh, kind of moment, almost like there's so many in movies, but one that comes to mind is I think one of the Matrix movies where they kind of pierce through the cloudy, stormy skies and see the brilliance. I think, I'm assuming it's supposed to be the sun, and it's just to take your breath away moment, sort of like that type of thing where you're just like, man, I already thought this market was a juggernaut. I already thought this market was really jammed. I really thought we were overvalued. I thought the market was extreme, complacent, blah, blah, blah. And then they just tack on this final move that'll just really, really leave you slack jawed. Hasn't happened yet. Doesn't have to happen, but that's often the case. It really is the punctuation point for this type of a rally. So that's absent to this point. I don't know if it's just that everyone loves the semis, much like everyone loves the market, and everyone loves calls. Everyone loves leverage. I don't know. Is that part of the problem as to why it can't go? It certainly hasn't stopped other things that are very widely held and probably over leveraged, et cetera, et cetera. I do think the market breadth snapshot took a turn for the worse. And I also do think that the sectors picture took a turn for the worse. So that adds to the intrigue. That's why I'm calling this another betwixt in between. Everyone that's been watching these for years or listening to me for a long time, for whatever reason, they're masochists, I guess. But whatever the case may be, this is one I trot out from time to time, and that's really when we're in this situation. And so I already kind of sprung this on you, but are we on the verge of the super melt or the rug pull? Right. So we have a lot of factors that are arguing that we just continue to just up and away. And I would say without news developing, and it could be financial markets news, it could be some sort of a currency issue starts to become center stage type stuff. And then, or you could have other factors, right, that just geopolitical clearly, but other economic financial factors could happen. It's problems with the system. Anything could break loose at any time and change it all. But without that type of thing happening, I still think that despite being overbought and needing a little bit of a pullback here, I think the market is set to continue to go higher without that. So that's just the way the charts look to me right now, despite the fact that I did get much more concerned after I reviewed the charts this week than I felt last week. So I think I'm getting much more concerned, and that's just the bottom line. You got to call it like you see it. That's what I try to do every week. Anyway, I think complacency is busting at the seams. I already talked about that modern melt, right? We haven't gotten that super modern melt up. And as I noted, it's not a prerequisite. I would be point blank. I would tell you to be at DEFCON 2. We haven't talked about DEFCON and Esterhaus that much because the market really has been the market, right? So we just really, like, you don't want to keep hitting on that hard, right? If you're me, trying to have everyone a little too gun shy about riding longer, so on and so forth. I don't want to be in the back of someone's head having them think, oh, well, this guy wouldn't do it. He's been doing this for a long time. No, I mean, I do think you have to be that way. I talked about that in webinars this week in Cocktail. I talk about it a lot because one thing I really hate to see, two things I really hate to see really are folks missing out on great opportunities because they have a problem with the market, the Ponzi scheme, whatever. So do I. I might even have more problems than you, but I just learned the hard way a very long time ago, by the way, that you just got to go with it because otherwise you are missing out on a lot of opportunity. So you might have even better points than I could make at this juncture. And I used to stay on top of this stuff pretty closely, but life anyway. Yeah. So I agree with you. Probably a lot of your arguments or concerns. I would just say that, right, I had those concerns a quarter century ago and the Ponzi scheme roars on. I don't know when the Ponzi scheme will end. It will probably end ugly at some point, unless maybe there's some sort of miraculous divine intervention type thing. But for now, the Ponzi continues to march on and take no prisoners, as it always has. And so look at the opportunity just in the last couple of years, really, when there are really still problems here and there, excuse me, and you can't fake your way to prosperity forever. You can't print your way to prosperity forever. You can't indebt your way to prosperity, right? You can't have a societal decline your way to prosperity, but that seems to be happening. But remember, everything's dollar denominated, so it's a little bit of an illusion to a degree, but that's a whole nother discussion. Anyway, that brings us to where we are, though, and that is right that I think because of the current mix, you've got to be at DEFCON 2, you've got to be going with the trend, not fighting it. There's still potential, but I do think we're just getting close to it across the board overboughtness that's mixed with a very, very high level of complacency. And so a lot of you know I'm really what I would say is a 70 Delta guy. If I have my druthers, the 70 Delta option for short-term trading sets up nicely for what I like to do and how I view things. And when that goes deeper in the money towards 80, 85 Delta, and I'm still in what I perceive to be the early innings of a move, I'm going to roll back to 65, 70 Delta to keep with it. But when I do think the move ages and we're getting towards the latter innings of a move, of course, I'm not sticking with 70 Delta on my rolls. But even in the early innings of a move from here, I would really not plan to go from 70, get into 80, 85 Delta because I caught the start of a good move and then rolled back into 70, like 65, 70, like I typically do. I would definitely consider rolling to out of the monies, because if they do melt this thing up, and they could, if they do melt this thing up, you're still going to probably celebrate very strongly. So you're still going to be a winner in that case. And this way, right, you're not allowing yourself to get too far over your skis in case they do pull off a rug pull at some point, because you don't want to get caught. So that's the betwixt in between. You've got to keep going with something, even if you're uncomfortable. And signs are telling you that this thing really should peter out soon. But if you try to force that too early, you can A, get hurt, B, sit on the sidelines while the good move happens. And that's really the B&B comment here. That's what this label's all about. You don't want to miss out. You don't want to get caught. But what do? You don't want to sit on your hands, right? Because you got to be in there. That's what we do. So that's what I'm getting at. And I think what you do is you just do it in a very smart, disciplined way that's even more, let's say, refined and maybe a little more risk averse, a little more prudent than how you normally would, because you sense that maybe there is a great deal of complacency and you are maybe towards the latter stages of a move. Hard to know for sure. Anyway, that's it. So we just identified the nutshell of the betwixt and between issues. And there's almost always issues that people point out when you've arrived at this phase or leading up to it and even through it. But as I've already said, you've got to keep playing the game while the music plays on, right? Otherwise, you end up with that wallflower frustration, because a lot of people will get that. I had it myself many times, because I was like, this is total madness. And boy, that party just raged on, and then I would get in again and just take small little bits of it, because you can't sit out forever, but not really have played it as aggressively as I should. So that taught me a lesson. And a long time ago, fortunately, in the late 90s, and I think it was like 98 when I finally started to figure out that like that it could just keep going and going and going. I can't even remember though, but I was just like, all right, well, I got to get back into this thing, because they're just going haywire, and you got to make money. You're a trader. So I do think, though, I've been talking about my spidey sense on and off, mainly like leading up to the election. And in a nutshell, my spidey sense is probably it's been dead wrong or early, one or the other, but let's just say dead wrong. I don't know what happened. I think there's going to be something that comes out about what actually happened, but there was some really strange stuff happening on election night that seemed to get quelled. I don't know the full story on that. I'm waiting to see if anything else comes out on that and a few other things I've come across. But that wasn't my only reason for thinking that it's more of a that Trump represents the change, right? He really is who he's purported to be, for better or for worse. That does theoretically set up this battle between this agent of change, right? That's apparently has significant support across the country, and the entrenched you know who's. So if people are going to get frustrated if the entrenched you know who's try to undermine what they think is coming. But the really important factor there, along with that, might just be that if, according to the financial media, the market front ran the Trump victory, and that's what they've been doing now for over a year. So if the Trump if the Trump victory is one thing, but the Trump agenda is sort of another, and if Trump doesn't get done or has no chance of getting done or is being undermined by the Republican Party, which I think is very predictable, uh, that could be a problem for what was expected by some, right, in terms of the Trump agenda. And so that could be the problem. I don't know if that's what's going to culminate here between now and, let's say, when Trump is theoretically sworn in late January, mid to late January. I don't know what's going on with geopolitical events. We did have a massive VIX hit, which I'll show quickly. And those have been really sort of on the lighter side most of this year. They usually are a little bit more, certainly a little bit more active in the VIX. They haven't been, but we finally did get another one. The world is just not firing efficiently economically yet. And the forecasts as of now, from what I've seen, are not stellar too. So this is sort of the problem of, did they front run too much wonderfulness into, no, that could have just been smart traders saying that the public's going to get all jazzed up ultimately, and they're going to buy this once it's elevated, as they typically do, which is sort of like they buy contemporaneously while theoretically professionals are loading up well before then to acquire inventory and then offload it. So that's that. The public, of course, has gone all in, and more so recently by a good bit. So it's sort of like, okay, there are some things out there, and we should probably be on guard in terms of timing. But that's, again, betwixt and between, because you've got to keep playing this trend and this momentum as long as it's there, and it could carry on for a good long time. I mean, remember, we were talking about, depending on how the market would move higher, the price action, how quickly it would do this, that, or the other thing, there could be a lot of upside. And I think in recent weeks, we reviewed it and said, there was another 10%. This is before the recent pop, we saw the last week or so. The market probably had 10% more upside before it ran into trouble on a longer term, if it can keep going. And I think I was saying sometime maybe in the first quarter it could get there. But anyway, that's a whole nother subject for now. I'm going to do a tabs check. Don't hate me on this one. I think you're going to find it worth your time. I held off long enough and saved you from tabs checks to this point, so don't get mad, and don't hate me because I want to see traders protect their gains, because I think this is one of the most important long-term super performance factors, where if you can even read someone like, as loathsome as George Soros, but he has a good point, that if you avoid giving back a ton when everyone else stays super long and exposed, and you can just protect yourself to a degree versus them, maybe a great deal versus them, you can really crush it, because you're taking out that big negative wave right on the way back down that a lot of people just ride all the way through. And so it's a lot easier said than done. We all know that. But if you know when to be on guard, and I think now is a time to be on guard, it doesn't mean fight. It just means you have to be cognizant of what's going on here and how these risks are building and things are getting extended and set, et cetera. Then you can collar, neutralize, you can portfolio hedge. There's so many things you can do. You can talk to Ryan about that in Phoenix or one of the other webinars that we've got. But that's the kind of thing that, I would get on top of if you're unfamiliar. Bill Johnson, Stu, the rest of the guys, Scott, you get on top of all the things you can do, so you know what to do and how to do it. Maybe like look for reasons as to when to do it, or timing is when to do it. I just want to give a little bit of a heads up on some things I saw. I did see some interesting things the last couple of weeks in the crypto space in UOA. The coin is one of my favorites. When they start to get their hands on that, it can really go. We did have a MicroStrategy super burst. We saw UOA on, got an idea in. Boy, it took virtually the next day. It was jammed up through our short strike, and we had, I think, a $30 or $40 wide vertical on, and it just boomed right beyond the short strike. So weren't close enough to expiration for the vertical to max out, probably. But it had to be, I would think it had to be a really good gain. I think the trigger was around 385 and the thing went to like I don't know, 445 or 450. I can't even remember. Anyway, also PayPal UOA looked interesting. And then on a related note, we have had ARC as a long too, but SMH, we'll try to talk about that. If the pullback in the second half of the week remains shallow, this might be one to look at, only because, right, it's SMH and you know what that implies. You know the implications. So if we get a shallow fib retracement on this, and they start to work this thing back up, that would be an encouraging sign. I would definitely keep an alert on that one. These are ones I would keep alerts on. Tesla, also, I would do the same thing. Now, I will warn you that especially on these last two, there is some ridiculous overboughtness in those right now. But as I've said, right, until you start to see it crack in some important level, worrying about overboughtness can hurt you too, right? So if you can make the argument, well, I've got other setups that are not nearly as overbought that look even better to me, 100% I agree with you. I'm just saying that if they go into melt up mode, these things look like they have more melt potential, is my point. And that could still run despite being ridiculous already. So just kind of note that. I do think they're ridiculous, but it depends on the environment that they bring forth the next week or two, so just keep that in mind. Might be worth an alert at the very least. And we're going to just have to do the charting in real time because I'm too pressed for time. And I think that's it for now. So let's just stop the share. And then this is when everyone is going to start snoozing. So you may want to just get your coffee fired up here, because let me get back to we are going to do the tabs check that everyone hates. This is actually my favorite time because I hate to see people give money back. And I don't know if I'll be right about the concerns that I have, but I'd rather mention them. And remember, I'm not turning into a bear here, by the way. I'm just saying that you should probably start respecting your risk. And let's start out with this one. Hopefully everyone's seeing something we haven't checked in a while. CNN fear greed. We're getting a little bit of hesitation out of my computer. Oh, this is working right. Anyway, no, I don't think they're moving here. Why is this hesitating all of a sudden? You know what? I'm going to shut down if it lets me. I'm going to try to shut down my PowerPoint here. In task. Okay, so what I tried to do, hopefully this is picking up on the recording. I'll be really frustrated if it doesn't. But let's see if it's recording. Yes, it says it is. Okay, so let me get back to the share. Of course, the Zoom conflict just continues to plague me. All I was doing is switching to here, and it looks like it's working now. But so I hope this recording is not interfered with too much. But you might wonder why we're back at Fear and Greed after such a sabbatical from it, and especially because it's neutral. But the interesting thing is, right, with the market really high, some things are just at extreme greed. And of course, one of those would be market momentum as they measure it. Remember, this is not a great measure. Notice, though, that 52-week highs are starting to really not perform. This is one reason why I wanted to review this. Stock price breadth, which I mentioned already, isn't really getting there. So now things are starting to show up. Put call, extreme greed right now. Okay, because people just don't want puts and they want a ton of calls. And you've got safe haven demand, you're in fear there. Junk bond demand, you're in fear there. So inside of a neutral rating, there's some definite signs, right? According to the simple, not that sophisticated, maybe not that great of a measure, but something we can always go to. The other thing is that AAII also bounced pretty strongly from last week to this week. And it's not really at the highest high, but it's gotten up there, right? So this starts giving you the flavor for a couple of different things. And then this is sort of randomly organized, but if you want to believe this that was put out this week, the volume in the Mag 7 had reached its lowest volume in years. And you might say, well, how's it going up? And that's one of the great mysteries of the stock market. But that this happens all the time. But again, maybe the appetite to buy those things that are pretty much probably owned by almost everyone isn't just there. And really, it's a momentum-a-thon right now without any really serious buying. Keep that in mind. This is another one where, just to let you all know, because we're on the subject of this stuff, the same game we've been highlighting for years is still roaring, right? So just gives you an idea that this is a tremendous year in the S&P. Most of the gains, right, 23.7% of the 26.9 happened basically outside of regular trading hours. During the day, we're getting this to work with, right? So all the good stuff, they moved away. Like the great old days of day trading, they took that away from a lot of people, where you were getting a lot of this stuff happening. They just started moving it into the futures pre and post market. Nice. But anyway, that gives you an idea. This has been happening for a very long time at this point. This is the global economy. So this is what I was sort of alluding to, that you are seeing Trump wins, but look how this global economy really is falling off a cliff, if you want to believe the Goldman Sachs Global Map Surprise Index. So this is really not, right, this is the world not firing. This is the recent home sales data. So there's been big arguments about how a lot of things were even more egregiously manipulated than is usual by the government. It could be true. I guess we'll find out. Maybe we'll find out. U.S. executives bailing at extreme levels. Okay, there's your ratio of sellers to buyers right there. Excuse me. It's up there. Institutional investors have never been more bullish. So everybody, right? Everybody's a bull pretty much versus any time in histories, according to that. Now, I can't verify all this, obviously. I have to just rely on what they're reporting here. So U.S. jobless face longer spells of unemployment. Not a good sign. Americans have never been more confident in the stock market. So this is basically I think bull versus bear. So this is really skewed. You can go look at these yourself. These are just some of the guys I try to follow. Ryan tries to follow. There's your welcome to 2021 options, right? Your speculative call volume. It's a call versus put, excuse me. Like I said, it's getting very one-sided. This is another story. Just have to mention this because I've been long silver and gold and all that stuff for several years, and just wanted to throw this in there because we've talked about how short the manipulators are, right? The banks are for a long time. This is no secret. It's not even breaking news, but there's quite a bit of ounces that apparently are short in silver if that thing ever does somehow break out of their clutches. Here's a great example. The reason I've got this in from this Holger, I think it's Chapitz. You have to do a different kind of tea. I can't do it anymore compared to my old days when I lived in Germany and traded over there in the 90s. But anyway, the rally here is detached from performance is the point. But the reason I'm showing it is not because of the Ponzi or how ridiculous it's really because the DAX is up 414 while the economy has only grown by 87%. And this is something that we often talk about where you don't want to overdo it and say this doesn't make any sense. The economy is not doing this or that or the other thing. You don't want to sit these things out because these things can act really right independent of what's happening in the economy. And yes, to a degree, it seems like they should be related. And I think ultimately they are, and they really should be. But that relationship really is volatile over the course of time. So, this is a great example as to where if you just keep looking at the economy and not what stocks are doing as a trader, it's probably going to hurt you. And I just wanted to emphasize that. Here's your all-time U.S. market cap, $60 trillion, right? It's double the rest of Asia and Europe, double. Here you go, global equity markets price to book. Here's the rest of the world down here. This is from Tavi Costa. Here's the U.S. This is how in demand or how priced the U.S. is right now. U.S. stock market's never been so concentrated. Okay, dot-com bubble ratio did not surpass 600. We're now at 750. I'm just trying to give you an idea of what's lurking out there. Here's just a relative measure of U.S. stocks to Hong Kong stocks. So you can see how the U.S. is expensive relative to Hong Kong, or the U.S. right now, Hong Kong, or you could say the Hong Kong stocks are cheap relative to the U.S. However you want. Just gives you like that comparison of another place. Here's your price to book. Price to book is now the highest ever, apparently. Just letting you know, just a messenger. Here's the valuations in a different measure, 22 times forward versus 14. Now, here's the weird thing. It's the widest valuation gap in history for U.S. versus international. So take that for what you will. The other thing is that I saw where they were taking down estimates. So I'm not sure what's going on. I'm just letting you know, again, this is the dichotomy between the underpinnings versus the stock market action. And we have to trade the action and just be cognizant of this. Is the whole point of this for me. Anyway, this is the other side of the argument. If you sit things out, right, this is you cumulative returns if you bought bought the all-time highs. So as much as it's seemingly kind of like, you're right, it's a little bit of that, like, what? If you invest on any day or invest at a new high, right, this is the comparison over the course of time on your holding period. So it just shows you that buying these new highs, maybe there's better ways, but doing it on any random day versus just buying when their markets are really running, you can do better when markets are really running. Really just confirms momentum for me. But I just wanted to show that because hopefully this helps. If we keep going, this helps people not be fearful, especially trading in the short term where you can roll aggressively and I get set stops for your rolls, and all that. But anyway, this is another one where here's the buy and hold. This is this one here. I'm trying to recall what I read this earlier. Market timing. Okay, yeah. So this is an argument against market timing. I'm trying to recall because I had so much in my head here. This was okay. Yeah, that's what it was. So this is if you would perform if you only bought the highest day of each year in the long run. So buy and hold when you actually buy at the very worst time you can for that year, which is at the high. Which sounds contradictory, but I just wanted to show you that still buying at the high and holding in the long run, it's different for an investor than a trader, right? So, but that is very interesting, right? That you can still do better according to this versus some market timing approaches that some people use. You can literally do better with buy and hold if you even buy at the very highest high of the year and lock in there. That's what I was getting at. Why I couldn't remember that, I don't know, but I just maybe too much stuff in my head. Here's the skew index at a new all-time high. So there's apparently a lot of pros again are hedging. Just to let you know that. Um, Again, this has been the case though, and they've hedged just like me. Their hedges have not been necessary, right? Or you could say, wait, they've been wasteful. So unless you just value peace of mind, which I do, knowing that how hell can break loose. General public is super bullish. We're at an all-time high in the portion of the general population. There you go. So all-time high. You got to go back way, way back, and you still can't find anything. So this is right. This is just giving you that flavor, um, just in case, right? Just in case protection, despite what we just saw there, it's a generational lows. So if you wanted to, it's there for. In other words, despite so many doing it, you would think the demand would have driven that up, but because there's such a, I guess, willingness to just play the bull side, it's not, and you can still get in on stuff. And I would just mention this in closing, that this VIX hit right here is what I brought us here for in UOA. So we finally saw something again. There was one maybe a few weeks ago, maybe a month ago. Can't remember exactly. That's quite a hit though. The 22 Jan 20 calls were bought for just about a buck, 128,101 times. So just want to give you that idea right there. So maybe something to keep track of. Note that that's right. That is the Trump swearing in inclusive, right? Or theoretically Trump being inaugurated inclusive. So anyway, that's a very interesting development there. Now we're going to move into the charts finally. This is what I'm getting at with ARK. I think you can see, and I did mention ARK as one of the stocks, and you can see right here that this thing is up there, right? So I've got some Bollinger Bands on here. I would say it's probably like 2.8 standard deviations from the mean, which for me is the 100 SMA in dashed white. So there have been other stretch periods with this, and it represents what it does, and that's why I'm focusing on it. Aside from the UOA that we have had a good little run in the UOA. Probably been a nice little moneymaker for some people, courtesy of Tesla. I would think maybe, and of course other names too, but mainly probably the Tesla run. But it's still has more potential. So I'm saying, okay, I can see that it's got the more potential. If I give you all a little bit more to work with here, I think you'll see. Well, maybe that's not the right chart to pick. Let's do a 5-year. But you can see, right, it's got more potential. I mean, I think it can go up towards probably like towards 70-ish would be a good ballpark number to throw out. So that's a good 10% move up from here. It just doesn't do it right from here and just go. Now that would really be the melt. That's what I mean by kind of like the super melt. Like this is already absurd, and you're looking at something that's probably around 75 on your RSI already. You're looking how stretched it is from the Bollingers, which have widened out dramatically, and yet, right, it's been relentless, and yet it could keep going. So if you get that super melt to 70, that's another 10% for this market in the very short run. That's what I'm kind of think I'm talking about, because as we saw, we're already up 27% roughly this year in the SPY, according to the one post we saw. So you've got that. You've got this one as well. This looks to me, right? This looks really interesting. That's too much data. My bad. Let me try to. Yeah, there you go. Try to get you more focused in here. Another one where the bands have really widened, and you're already getting up there in terms of your RSI reading. I mean, I think again you're at near 73, 74 on RSI. So this has gotten a little excessive already. And if they were to try for that all-time high up here at 415, you would think that in some ways Musk is positioned better than he was back here in late 21. Maybe other ways he's not. I don't know. I don't have the time to follow everything as closely as I'd like. But this is really a hell of a move, obviously. On the weekly chart, he's at 74 with his stock price right now. So he's got a pretty high RSI reading. You could see that some other measures here are really getting jacked, right? You're not maybe at the highest highs in terms of some of these measures. But remember, there was a COVID response that was, again, insane. That's really the popular thing, just to be insane these days. When they did whatever, you could call it 7 trillion. Some people say 11 trillion. Some people say 5 trillion. Whatever, between the Fed and the government, they came in with I don't know, nearly half the economy's revenue. I'm sorry, economy's sales number or size, whatever you want to call it. You could call it GDP, whatever you want to call it. But yeah, I mean, this thing still looks like it has more potential if it wants to go challenge. It's just a question of when. Already ridiculous. I'll look at the other ones quickly. I'll look at the coin, but I'm not going to look at that on a basis of big time basis. Let's just look at it more in the short run. And you can see that also is already overdone. I want a little more time than that, though. Let's do 9 months. So it's a little bit overdone already. As you can already see, you're getting up there towards the mid 60s on RSI, but you're not really nearly as bad as you were on RSI about 3 weeks ago. There certainly could be another leg here. That's why I'm kind of saying, like, if they do take this market into melt up mode, this could really burst ARK. It could help ARK burst. And there's still room before this gets there. So this is approaching it, right? It's approaching overbought, but it's really not there yet. So there's still maybe some more juice if that's the path that they take with the market. So that's another one I would just kind of throw out there as a potential. And some of the other names, of course, I've got ideas on some of them in EOA Pro already. Let's take a look at SMH. So SMH, this is what I'm going to talk about on this one. Let me just maybe, can I pull this over here? I might have to do this. Hold on one second. Let's see if Thinkorswim and Zoom torment me. So what I'm going to do is just measure here on this, the fib here from here to here, just to get a retracement level, something shallow. And I will, because I'm the way I am, I'm going to take it down to the penny. So we have that nailed. What's the low here? 234.17. We're not too far off there. We can fix that, get that set up so we're on target. So on this graph on the left-hand side, the 38.2 is about 246.09. And the 50, it looks like the 50 is 243.82. So I would say, right, a shallow retracement would be the 246.09. I would still stomach the 243.82. You have to if it happens anyway, right? But if you do keep it pretty shallow and they start going again, that's, in my book, usually a better sign. And so you really could, at that point, if they just have this and then they have this little pullback to somewhere between 23.6 and 38.2, and they start working this thing back up, and this market remains buoyant the way that it has been, I think you really have to still keep an eye on this one. I'm not saying it can't fall apart. Remember, I did say, is it kind of a warning sign? There's something really wrong here in a critical area? Or is it just the gang playing possum, as they're so want to do, and they're actually so very good at? And it could be, and they could be pulling that off, waiting for like a late in the game sort of maneuver. But if it gets through here, right, there's gap fill potential and all that. So I'm not saying anything yet. I think you have to wait for more data to develop, but it's still not knocked out, right? This thing is not knocked out in my book. So keep your eyes on that still as a leadership area. If it can reemerge, we'll talk about the NVIDIA as well on that. And it's a similar thing there, right? They had this nice little move, and then they pulled this thing back. And I'm not going to get the fibs here, but probably going to want to keep it above the 10-day at 140. Let's call it 140-ish. So if they can hold it there and then start to work it back up, we could draw a line right across here. And if you could bust out from there, right, then you're starting to work your way back up. It would be much like something like this, just in a slightly larger degree in terms of the scope, right? So you can see that, kind of get that triangular look, and then you bust through. It'd be something similar here, where if they get bust through there. There's a flat line there. The whole works. That could help launch it. It could help launch certainly SMH, and it could help launch naturally XLK, and that would only help the QQQ, which to me, right, we said it last week. We thought that the Qs really were curious, right? They were looking kind of interesting if those megas get going. They're overbought to an extent, but they're not. I would say not fatally overbought just yet. They could certainly get more overbought, but they still have sort of, not to say they haven't performed, but they do have some catch up room versus the SPY. They still are lagging the SPY's performance recently to a degree. So there is still potential. So this is why we're betwixt and between, because you're in the middle of what's probably, or could be at least, an abnormal super momentum juiced up market, and at the same time the complacency and other factors are starting to really become concerning. If you look at market breadth while we're here on that subject, which should appear here, or here's our very simple look at it, and you can see that new highs are tailing off. You can see that, as we noted earlier, the McClellan summation, McClellan oscillator, they're both not really loving what's been happening lately at all, to say the least. You've got cumulative volume tailing off here versus where we were at the end, towards the end of November, and you're a couple of weeks removed there. Here's all your stocks above the 50, the 100, the 200, respectively. That's tailing off. It's certainly not as good as it was back here, right? Certainly not. And so there's all these little things cropping in. It's not really, I don't think, panic time. But what I would do, and this is what I do, and what I've done for really probably the entire time since I got on the floor back in 92 and started to really chart more seriously, from just being a kid and someone who then had time to do it here and there. But this is what I would do. I think your clear level here for the Qs right now on the downside, where you'd start to worry a little bit more, that's going to have to come back in near probably, or let's just throw a number like 517 on it. So you've got about 2% before you get in big trouble. But if you notice on this, if you want to worry about a get in early to sort of fight against this thing, which I'm not sure that's the best course of action, but if you do, I think that Friday low could be used, or at the very least the Wednesday low. 519.60 is the Wednesday low. The Friday low is 522.35. But the real, probably the real area where it if it cracked, this would really maybe crack for real. It's going to be, I think, around that 519 is where you really start worrying. It might not. It might be a play around zone, but where they just play games around there. But that's probably when it starts taking on a more serious look. And so you could maybe adjust the line a little bit now that we're on this view, just because the slope changes due to the scale. But there you go. You've got the gap closure that kind of comes in there too. So if you wanted to sort of fight against this, and knowing that we're kind of frothy, overbought, so on and so forth, you probably need to stick with the if Friday's lows being exceeded, or Thursday's lows, probably Thursday's lows or close are your first very super aggressive level. This is a little more aggressive on the Wednesday low. If you really think the market, what I would start worrying about, if you start thinking this market's really going to start struggling, it's going to be right near, probably right around 515. Really starts to get worrisome, 515-ish, 516. But remember, this is why it's so hard to make money on the downside in a very strong market, because you got all these stacked and sloped SMAs just waiting to catch and support the Qs if they did roll over. So usually, right, moving average players, which there's a lot of, like to see things fall to there, and then they like to start setting up their buying plans, or I should say fall near there. But as far as upside potential, we're still using the old line, very simple old line we've been using for a little bit now. And you can still see that even as messy as this is, I have this line here as our more sort of near-term target line. And that's got it going, I would say that's got it going up almost 20 points, another 4% from here, before we would think that, it really is bumping up against a resistance line that could give it some real trouble. The bigger line back here, and I think maybe it would be it serve us well just to flip to a more of a weekly at this point for view. So that would put you sort of at 544 here on Qs. But you can see the bigger line takes you up depending on how fast you do it, right? The bigger line just keeps taking you up and up and up. There's more potential there. So there's plenty more potential in this market. It might not, right? I don't know if it gets realized just in a straight line. Of course, I just don't know. But again, that's why we're betwixt and between, because we're already frothy, we're already having trouble, and yet on a lot of bases that if you look back in history, you really don't want to play the game too big when things are this sort of frothy or silly or one-sided or whatever you want to call it. But you can't really fight it when you first hear about it until the market starts telling you to. Here's the PayPal. I'm just going to backtrack on that because I just wanted to note that I'm just a big believer, and I like to look at things many different ways. Unfortunately, a lot of you know that only too well from spending time with me over the years. But this big picture potential here is quite good. That's sort of a cup and handle type thing in my book. Maybe you've seen better examples. I would say you probably have, but it looks very intriguing there. I do think it's short-term overbought a little bit, or getting there. I do think it's overbought on the weekly. So I'm not really saying this is the easiest money you'll ever make. But if they keep with the UOA that came in, the way these charts look to me, if the market remains buoyant, I think they try to take this thing up. And just to kind of stick with the simple trend line theme, I don't know why I feel like this is sort of like I don't know why, but I feel like this is a little sort of irrationally hated. So I see so much hate out there for people that like to draw support and resistance lines. But the world, I guess, isn't often short of hate. But in this case, I don't understand why. It's just such a simple, like time-tested tool that just gives you a good sort of visual sense of what things could look like. And a lot of times these lines end up mattering after they start out mattering a lot. The trend slope changes, right? You either lose momentum, gain momentum, but then eventually you end up finding a way back to the line. Ultimately, it happens a lot, and so that should just give you a visual right there. Now, again, that's another one that I had some EOA, and the guys found some EOA, and that's an idea there. Just in case things do continue to rock and roll. Let's look at the SPY. The SPY, you're going to see that. Right, it's very similar, a little further ahead, I think, than the Qs. We could probably add a line in here if you want to get more aggressive. Talk about more. We haven't talked about this in a while, but you could maybe start doing the kind of like the rising wedge discussion a little bit here, that kind of thing. If you want to start adding more lines in, I'm not going to go through all that. I'm just going to stick with probably the worrisome area is Thursday's low at 606.30. That could mean, right, you get towards 70 on the RSI. You're not quite there yet. It depends on how you calculate it. On this screen we are, but on other ones you're not. I think this one I'm running a 13 just to have a little bit of advanced warning, but 13 on my daily setting. But anyway, this could certainly pull back to the rising 10, which would also put it near where we have this line drawn, which probably needs to be adjusted a little bit. Honestly, let me just adjust that. But I could see that. Then, I always go incrementally. So that's what I always, I've always said that. I don't try to, because I want to be very open-minded in my thinking and just be free of pound the table projections that I dig in too much on. And because I think the market really rewards your flexibility more than it does your stubbornness. So consistently. So anyway, that's a whole nother discussion. But yeah, I think this would be a natural pullback level towards the 10, towards that support line I just made blue. That's going to put us near that. Let's call it 604-ish if it were to happen quickly. So that would be the next level down. That's when it starts getting a little dicey. I mean, could you drop down to the 20 in blue, and which is near the 15 in red? Sure, you could, right? If there's a little bit deeper. Would it be the end of the rally? No. I mean, there are, as we said, there are some issues with breadth. There are some issues with the sectors right now, they are not looking as good as they did. You could see that this whole column, right, this really took a turn for the worse last week. The materials, the industrials, then the utilities all took a turn for the worse. So that is not good. I think this maybe is more global, these XLB, XLI issues. Notice too that we got a little crazy here on XLY discretionary. Transports did not participate. They had a rough week as well. So did energy up here. Very rough week there. So you got to be careful with some things starting to detach from the beautiful picture we'd seen kind of leading up to this. Things were looking pretty good, but we've had some deterioration here. So again, another reason to be on guard. Real estate's backed off. Healthcare, XLV is backed off. Financials are hanging in there. They've been champs. Meta, XLC, Google really roared. So naturally, XLC has been a champ. XLK finally got back squared up again, like we thought, with the mega caps and the Qs doing their thing. And actually, that's going to help. But boy, this would be helped tremendously, right? If they could really fire semis, as we've talked about, keep that retracement shallow, they could maybe start to really power that thing. My recollection is, and I don't have my, Ryan and I kept a heat map of sector performance, and I wish I had that at my disposal right now and it was updated, because I could try to show you what type of seasonality happens over the course of months and how historical and implied volatilities also fluctuate over the course of time, over the months, and so on and so forth. But if anybody wants to volunteer to keep that data up, we can get you the up to date. We can get you a spreadsheet if you could do that, and we'll just all share it. But that's really great data to have. I love having that data, and we just can't keep up, frankly, period. That's the end of that discussion. But yeah, so this is problematic here. I think that this is potentially problematic. There's certain things that still look stellar. I think just XLY and XLC are probably overextended though. Let me see if I can come back to this. I'll go back to here. Let's just do a simple XLY over here on the RSI. I'll mouse over this so we get the current RSI reading on it. So just to give you an idea, RSI in the daily is at 80 on consumer discretionary. Oh, by the way, we have a Costco and Walmart bullish ideas right now too, but these are juggernauts. It's just that this is exactly, I'm so glad that I brought this up, because this is exactly what I'm talking about. This thing was already getting stupid in terms of your technicals, right back over in this range. You were already getting towards 70, normally, and you had negative divergence there too on RSI, and your volume wasn't looking all that wonderful. But then suddenly, right, boom, 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 the volume shoots up. They're coming for it. They're just coming for it. And I have WMT. I don't know if these things fired, triggered. I don't even remember when I put them in, because it's just been crazy. But I would be very careful, right, with some of these readings. Walmart's at 83 on the daily. Costco, let's see where that one is. I mean, it's a juggernaut. This is at 70 on the daily. Just to give you an idea, it's 80. It has an 80 RSI on the monthly. This thing just cannot be stopped. But let's take a look at XLC, since that's another kind of world beater sector. And this thing is what? 77 on the daily RSI, 79 on weekly and monthly. So, this is what I'm getting at, is these things are, you don't want to miss this, but you don't want to get yourself clipped here. You do not want to get yourself clipped. You want to be smart about what you're doing. I think you've got to be, let the moment get the best of you. Definitely keep yourself super disciplined during this phase. And let's all hope it keeps going and there's a great finish to the year. I mean, I'm not ruling that out. I'm just saying that I've seen that happen before. We showed it a couple of weeks ago, maybe even last week, about how they just get a hold of something, they won't let it go. That could lead to, right, if they pull that scenario off really 2 years end, you could have that tax selling that we've seen before, where suddenly, like, everyone's like, okay, this is stupid. There's all kinds of problems here on valuations of where we are. and all other issues to boot, and insiders are selling, and Buffett's got cash, and you can go on and on and on. I'm dumping it. I'd rather dump it now and get back in, and everybody heads for the exits, and then you get a real early in the year swoon. And remember, after really strong performances, you often get really rough ones too, or at least you get retracements. So after the kind of back-to-back years we've seen, which have been pretty much extraordinary, right? I really wouldn't want to have been short or fought these things. This is why, even like despite my own reservations, I show up here week in, week out trying to say, but yeah, but the charts say this, but the charts say this, because I've always said, during even pre-market rebellion years, the charts aren't right all the time, or I'm not reading them right all the time, but they probably lie to me the least among anything on Wall Street, which is filled with liars, right? So that's the bright side of it. So I think this is just trying to be objective, trying to stick with the momentum. These are quantifiable things. You can look up papers on them. Trends persist, momentum persists in certain things, and it's been identified, and it's something you can participate in. Certainly options are too when they're liquid enough. So it's a pretty powerful combination. If you get it down, you harness it, and you stay within your means, and you just keep grinding. But I think this was a week where you've got to be a little bit more on guard. I do think that we saw enough in my tabs check and the other things that we discussed that you should, I think, have a healthy perspective in terms of, I'm not going to give too much away. And remember, despite all this, right, in that global economy cooling and the pricing that's built in, the 30-day VIX right here is just been mauled like you'd expect. And I don't blame them for mauling it. This is what typically happens. But you're not quite there, but you are getting down towards, right, some of the lowest levels. You're only a few points away from the 1062 low that we saw earlier this year. So just keep that in mind. Where's that right there? If that's right, that almost looks like a bad tick. But I do know we got down towards 10, near 11, and all that kind of stuff. But yeah, you're getting down there right when, of course, not coincidentally, right when a lot of this geopolitical stuff could really take a turn. I think the Syria thing, who knows what that sets in motion. Certainly not me. I'm not predicting anything. I'm just saying things like that can happen, and it can change things. And that's what you've got to be on guard for. And that's what's another warning sign for me that I have to share with you, which is that all these guys will basically, what they'll do is they'll ignore everything, and then suddenly they'll tell you it's important because they position themselves for people to believe that it's important now, and it's worrisome, and you should sell. So that's what they that's my opinion on what they do. I can't say that's what they do because I don't have the proof of it. I've just seen it far too many times for it to be a coincidence in my book. So right, they'll just ignore, and when they think they've wrung out what they can, then right, and they're ready for it, then they'll shift the story. It's not like the media doesn't take their marching orders from them. And then they'll be like, oh no, this really matters, and you should be really worried about it. And then stocks start going down, and they're ready to start buying back their inventory at some level that they already offloaded. But you saw what's happening there. So on that note, let's just do a couple more things. We'll take a look at the IWM and the diamonds, and we'll wrap this up. But not surprisingly, IWM, of course, the 244, 440. I continue to pound the table on this. I pounded the table on gold and silver, for you to be long, just that there's potential is what I mean. There's really big potential in these charts if they can go. Certainly taking out the all-time high and lagging behind the Qs and the spiders to the extent that they do in IWM, that would be, if that can get through, that would be great, but it's struggling. And this just tells you that technicals matter once again, because you're right back at the level that was a high. And here we are now for 4 or 5 weeks since the election, and you can't get through. Now, if you do, I think there's tremendous upside, as I've said, pretty much right all year long, because we identified that the Qs were lagging. But I still think it's there, but it can't get through, right? And you took another tumble. So as of right now, we'll go back to the daily to get a better look at it. So as of right now, you've got to be worried about this 2015 confluence area. Where's that about? Let's pull this number right here. That's going to be about call it 236. So down another percent, you can see where that opens up problems. There's not a lot of near term price action or support that we could cite. And there's a big space or clearance zone between the 20 in blue and the 50 in gold. So you got to be careful on that. If we do finally get a little bit of a sell off in this market, which I would expect would be unless it's driven by serious news, I would think it would be maybe swift, sharp, maybe a little rough, but I think they'd come right back after this market if the news is not sustaining. If the news is not a long term or medium term negative, intermediate term negative, they're probably coming right back for this market for the window dressing at the end of the year. But I would look at that in terms of breakout. On the flip side of it, I mean, you're not that far away as rough as the chart sort of looks right now. And that's why I believe in flexibility, because right, all of a sudden, if we're looking at, oh no, this thing's breaking down, and then they just jam it right back through, you'll have taken out this resistance line, which again, I would think is important. Not a lot of people really do anymore, but I still stick with them. And the real level probably is, well, you could say the all-time closing high, or should say recent closing highest high is right there at 240, 240. I think you get through 240, 240, and you probably have a shot here at that point. Whatever's causing that, if that story or those developments in the market are that important, significant, you could definitely finally punch through for the end of the year on the flip side. So I think you're really looking at, let's pick out a nearby number that's reasonable. Let's call it 241. The first area would be 241 to sort of start feeling a little bit better about this. If it can start getting through 241 on the upside, you're probably looking better. You're feeling like, okay, I'm above resistance, which has kept me tamped down now for a week and a half. You can see where the support would come in very clearly here. I think it's very clear that you, on the diamonds, you're looking at about probably around 444. The 15 day is at 443.71. So you may as well say the 15 and the 20 there in blue, which is at 442.78. So they're really close as you would expect them to be, given their proximity to each other mathematically. And therefore, right, that's where you would expect there to be support, and along with probably a flat that's right there at 443-ish, right? Just kind of a simple flat that's maybe improved with the fact that this led to a gap and it was held down that day, but then gap through. So anyway, that's where I would put that one at. How do you get back on board here? Well, this is probably so close to this closing high here, you probably have to wait for that. So you're probably looking at about 451 on the close. So you may as well just basically wait for this thing to start taking out highs if they decide to go that way with it. But yeah, I mean, I wouldn't, if you want to ask me about a most likely scenario right now, I think the most likely scenario is probably, and it's close to being like, I really don't know, but I think the most likely scenario is maybe you back up a little bit more. And then assuming that support holds on some of these things, then I think you're right back to the races, absent news. If they gun it right out of the books early on, I'm sorry, as they run out of the gates, then I would change my mind and say, be careful on a false breakout, because I just think things are a little overdone and they're not so wonderful. It doesn't mean individual stocks like Tesla, whatever, ARK, all the other stuff we talked about, PayPal, Coin, SMA. It doesn't mean some of that can't do it on its own, and you might have a mixed market that's got some real shifting currents. We saw that the sectors are a little messy. So some are still going gangbusters and overdue for a pullback, XLC, XLY. Others have already gotten messy. But I think with that global economy just not being there, that's got to weigh on you to a degree, despite the fact that the markets could ignore it for a while. But I think a lot of that XLI, XLB type stuff, that to me is probably predicated on more of the world doing better, not just the US. And I feel like they did front run this market a little too much as of right now, but there's also some incredible developments that could happen in the near future. And maybe more so based on the press reports I've read, maybe more so than usual. So there's also that side of the coin that's that you don't want to get too bearish and again miss out, because if there really are some amazing developments waiting, Remember, they're going to not only buy the hype, they're going to rebuy the hype, they're going to jam the hype, they're going to mark up the hype, they're going to melt up the hype. All that's going to probably happen before the reality of it sets in. So there still could be potential for that reason. So on that note, I'm going to end things. Did the best I could to cobble it together. Got a lot on my plate these days. It's going to probably remain that way all through next year at the very least. And we're just going to have to keep doing the best we can. So sorry this one ran long, but I really felt like it was time for us to really start appreciating the risks that are starting to crop up out there and to be really prepared for a possible pullback sometime soon. We'll see. I'm just believing more of a shallow one now. And then I think if they do have that, get it sharp and maybe sharp, relatively shallow, but sort of like that, sort of like quick, like whoosh. But then I would think they probably bring it right back again if this story isn't significant. And then they try to still work up into year's end because nothing motivates them like their own bonus potential. So on that note, everyone take care. I hope something I share with you this week helps you out this upcoming week or some week in the future. And just stay careful out there. Thanks for tuning in.